Your Excellencies, ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh. Good morning and welcome to today's workshop in the UAE capital, Abu Dhabi. This workshop marks the launch of a new phase of the FTA's comprehensive corporate tax awareness program. I would like to begin by expressing my great pleasure to see you and thank you for attending with us this workshop today. My name is Roda Al-Mhiri and I will be your Master of Ceremonies during today's workshop. In 2023, the Federal Tax Authority launched the first phase of its corporate tax awareness program, comprised a total of 48 awareness workshops, including 9 in-person workshops held across the 7 Emirates, and focused on explaining the general principles of taxation of corporations and businesses, in addition to 39 virtual webinars, which focused on clarifying the requirements and process for corporate tax registration. Today's workshop in Abu Dhabi marks the start of the 2024 Corporate Tax Awareness Campaign to introduce the general principles on taxation on corporations and businesses for small and medium-sized enterprises. Today's session will include an introduction to corporate tax, basic elements of corporate tax law, provisions relevant to small and medium businesses, calculation of taxable income, compliance requirements, private clarification, and question and answer session at the end. Ladies and gentlemen, I would like to invite His Excellency Khalid Al-Bustani, Director General of the Federal Tax Authority, to deliver his welcome speech. Please welcome him to the stage.
السلام عليكم ورحمة الله وبركاته. أولاً أرحب في الحضور الكريم، وفي البداية لا يسعني إلا أتقدم بجزيل الشكر لشركائنا غرفة أبو ظبي، صندوق خليفة لتطوير المشاريع، جمعية الإمارات لريادة الأعمال على دعمهم لنا في هذه المناسبة. إذا سمحتوا لي أنا بلقي كلمتي باللغة الإنجليزية لاستفادة الحضور الكريم، وإن شاء الله بيكون هناك جلسات كثيرة اليوم يشرحوا لكم فيها عن الضريبة. Distinguished guests, ladies and gentlemen, first of all, I would like to thank you today for joining us in this session. And the purpose of it is to have an awareness for an important segment in our economy, which is small to medium enterprises. So in FTA's new phase of awareness sessions, we are focusing more on the small to medium enterprises because of their weight and their contribution to the national economy. First of all, I would like to extend our thanks to our strategic partners, Abu Dhabi Chamber of Commerce and Industry, Khalifa Fund for Enterprise Development, Emirati Entrepreneurship Association for their support in the FTA and organizing this event and to promote the tax awareness in the business community. Distinguished guests, following to the implementation of the corporate tax on the 1st of June 2023, FTA have been playing a critical role in ensuring taxpayers and various business sectors understand their obligation under the corporate tax. We have worked closely with all relevant stakeholders to design and implement workshops, webinars, and several educational activities to help taxpayers meet with their corporate tax obligations. In 2023, the first phase program comprised of 48 awareness workshops, including 9 in-person workshops held across the UAE and focus explaining the general principles of taxation of corporates and businesses, in addition to 39 webinars, which focus on clarifying the requirements and process for corporate tax registration. We had impressive turnout for more than 13,600 participants, including taxpayers from various business sectors and benefiting from these awareness sessions. And FTA assure you we will continue with this effort in the coming future. Since 2017, introduction of the excise tax, and 2018 of introducing the VAT, the UAE witnessed a fast progress in introducing taxation in its economy. The purpose of taxation, as we all know, is the financial sustainability to support economic development, supporting infrastructure, and providing the best services to the citizens in the UAE. As FTA commitment, which is as part of their obligation, we will continue and support taxpayers with providing them with information, awareness sessions, publishing the latest resolutions on our website. So I do invite you all to benefit from visiting our website and follow up the latest updates, which provide you with all the guides and all the latest resolutions. I would like to explain here today that the corporate tax regime have been designed based on international best practices and resolved to put principle of fairness in the forefront. 0% tax rate for startups and small businesses in the UAE economy, which is profit below 375,000. The law provides additional relief to small businesses, which incentivize these businesses to establish and explain their activities in the UAE. Today, our experts will explain to you in more details on these areas. It's important for us and the FTA with the business community to work as partners. This is a journey we're working together on. And time is important. So as we progress in the corporate tax, businesses need to prepare themselves for the tax. So I would like to seek your support, number one, in registering in the corporate tax. FTA provides Emirate Tax platform, which is real-time online for the registration of the tax. We designed the registration to be simple for companies with already registration in the VAT. There will be an export of the data to the corporate tax, and businesses, when they register for the corporate tax, they need to update their information, because we notice that a lot of businesses, they don't update their information. So it is important to update the information and to continue to do that. So registrant in the VAT, it will be a simple process. And new companies who have not registered in the VAT, they need to register in the CT. And again, The platform is very easy, designed to help the taxpayers to use the system easily. And we have user guides that help them how to use the portal and to make it easier for them. It's our priority to work with the business community to comply, because the UAE and the FTA look forward to the strategic partnership between the private sector and the Federal Tax Authority for voluntary compliance and complying with the laws. There is a lot of learning to be done in the coming future, so therefore businesses need to learn more about the tax. And the most important challenge that I see, preparing their books and accounts for the corporate tax. There are requirements there according to national standards, according to the best practices. We want the businesses to ensure to start now, because we're running out of time. The year have started, and already the law started in 23 in June. So depending on the financial year, and my colleagues will explain when do you have to file, and the law made sure that to give taxpayers enough time for filing. But at the end of the day, it's the businesses need to prepare quickly for the tax, not to leave it to the last minute. I cannot stress enough the importance of early registration, because our experience in the VAT, people left their registration to the last minute. And this is where they had challenges regarding approval of the registration. So I seek your support to start registering now, because we have time to review your applications and approve them, and not to leave them to the last night before filing. So this will be a big challenge for everybody. So I would like to invite you today to listen to our experts and to have all the questions and all the clarifications. And I promise you, in the future, we are committed to support you, because it's a partnership, and the success of the tax system depends on our partnership and working together. I'd like to thank you all for listening, and forward to you discussion with our team. Thank you very much.
Thank you, Your Excellency, for your insightful words. Now, please let me introduce to you Rida Hamzawi, Tax Policy Senior Expert, Zubair Chaudhry, Tax Policy Specialist, Juliana Candido, Tax Policy Expert, to present to us Corporate Tax Principle for SMEs Part 1. Please welcome them to the stage.
Thank you, Excellencies. Thanks also to all the attendees for your time and for your dedication to attend this awareness event. Today, our corporate tax awareness session will focus mainly on small businesses with corporate tax aspects that are related to small businesses. Mainly the small business relief, and also the taxation of natural person, because in most of the cases natural person are basically their business does not exceed a certain threshold. There is a certain rules applicable to also natural person, a threshold that is applicable based on Cabinet Decision 49. Certain types of income for natural person that are not considered to be in the scope of the corporate tax. So basically, we will talk about today mainly the basic element of the corporate tax. As I said, the small business relief, the calculation of taxable income, compliance requirement. FTA also opened the portal already for private clarifications. So we will talk about private clarifications and what are the key requirements when submitting private clarifications. And then we will end with a question and answer session. But just to set the stage for our presentation, I think it's important to talk about the key policy drivers for the introduction of the corporate tax law in the UAE. Basically, the most important element and reason for the, or cornerstones for the introduction of corporate tax law, they revolve around these elements. The first one is the introduction of a competitive corporate tax regime. UAE has a very competitive corporate tax regime for many reasons. First of all, of course, the tax rate. Secondly, the existence of several exemption for specific person, exemption also for specific types of income. Also, the availability of many reliefs under the corporate tax law. One of them is a small business relief. We have also other reliefs, the business restructuring relief, the transfer of tax losses, the transfer within qualifying group, etc. There are also other regimes that are meant for larger businesses like the tax group regime, so Article 40 to 42 of the corporate tax law. And these kind of feature, they create a competitive corporate tax regime. And the second kind of cornerstone is the fact that the corporate tax regime is meant to strengthen and consolidate the position of the UAE as a regional and also a global investment and business hub. The third element is, of course, the acceleration of the UAE developments and transformation, and also the diversification of the sources of, income, of revenue mobilization for the government. The most important element is the fourth element, and basically it has to do with the confirmation of the commitment of the UAE government towards international standards, towards the standards related to fighting harmful tax practices and transparency standards. If we talk about the role of the FTA, as mentioned by His Excellency, FTA has a critical role in the implementation of the corporate tax regime in the UAE. Basically, this role revolves also around four elements. So basically, supporting the compliance of taxpayer, and the UAE, in the UAE, the Federal Tax Authority is providing guidance for corporate tax. Already 13 corporate tax guides have been published. The last one is the tax group guide, and in English, and also the natural person, taxation of natural person, also in Arabic. The guidance, public qualification, they provide clarification on how to understand and how to interpret the corporate tax rules. Also, the FTA provides technical support through the private clarification mechanism, and the private clarification allows to enhance the certainty for taxpayers. And I think my colleagues, they will talk to you about the private clarification portal and how to submit private clarifications. FTA also is responsible of conducting tax audit and checking whether taxpayers are complying with the corporate tax rules. And then finally, the FTA is in charge of the collection of the relevant taxes, in our case, the corporate taxes. And then, of course, this will take place with respect to the registration, and then at a later stage also with respect to the filing of the corporate tax return. Just to set the legal framework for the corporate tax law in the UAE, or the corporate tax legislation. So we have a federal decree law which is issued by the President of the UAE. The federal decree law refers to many cabinet decisions, and there are multiple cabinet decisions which are issued by the UAE cabinet. The federal decree law also refers in many instances to ministerial decisions, issued by the Minister of Finance to set the condition for certain requirement under the corporate tax law. We have also FTA decisions, so the corporate tax law referred also to the FTA to specify certain conditions, and then the FTA issued many decisions related to the corporate tax law, and the FTA decision are issued by the chairman of the board of directors. And then, as I mentioned, we have the guidance and the guides published by the FTA. So for corporate tax purposes, already 13 guides have been published, and many guides are yet to be issued in the next few weeks. The corporate tax timeline also, I think it's very important to set the stage for our presentation. Basically, the corporate tax law was announced, and the corporate tax regime was announced in January 2022. The federal decree law on corporate tax was issued in October 2022. Then the FTA opened the portal for the registration for public joint stock companies and private companies by mid-May 2023. And then 1st of June 2023 marks the starting of the corporate tax regime, and it marks also the first tax period for businesses or person with a financial year starting from 1st of June and ending on 31st of May. 1st of January 2024 is for most of the taxable person. It marks the first tax period for taxable person with a financial year corresponding to the calendar year. And then 31st of May 2024 corresponds to the end of the first city period for taxpayer who started their financial year on the 1st of June. 31st December 2024 is the end of the city period for most of taxpayer, of course, with a financial year corresponding to the calendar year. And then for the filing deadlines, so the filing will be on the 28th of February 2025 for taxpayer with a tax period starting from 1st of May and ending on 1st of June and ending on 31st of May. And then for most taxpayer with a financial year corresponding to the calendar year, Gregorian calendar year, the deadline for filing will be around end of September 2025. I think it's a slide that is extremely important to set the stage for the presentation. And then before handing over to my colleague Juliana, who will talk to you about mainly about the taxation of natural person and the feature of the taxation of natural person, let me highlight again and focus on the importance of corporate tax registration. The registration for corporate tax is the first step in terms of compliance. There are many advantages for corporate tax registration. The first one is the possibility to get certainty from the FTA through private clarifications. Now, private clarifications, they are available for taxpayers who are already registered for corporate tax purposes, unless your clarification is considered only with respect to registration itself, unless your question is related to whether you should register or not. Any other question, if you need to submit an application for the FTA, then you need to be already registered, and the FTA will require from you your corporate tax registration number. Otherwise, if you are not registered, then you will get a request to provide your corporate tax registration, and then you will need to register. So if you want to submit a private clarification, please first go and register. I think the FTA is making sure that the registration process is a seamless process. We are here to support you. If you have a question related to registration, we are here to support you, to answer your question. We have also a large team here that is available and that could support you in terms of registration. Thank you, and I hand over to Juliana to talk to you about a taxable person and mainly natural person.
Good morning, everyone. My name is Juliana Cândido, and now I'll talk you through the basic elements of corporate tax law. In this part of the presentation, I would like to better explain to you who is subject to corporate tax in the UAE, who we call taxable persons. So we have natural persons in certain circumstances that I will talk to you in further detail, as well as juridical resident persons, as well as juridical non-resident persons, depending on the circumstances. And also, I'm going to explain what is the corporate tax rate applicable in the UAE and the different thresholds, as well as guide you through the tax period applicable. So first point, I would like to detail who is considered a tax person in the UAE for corporate tax purposes. So the first step, the basis is the Article 11 of the corporate tax law. And the way that the corporate tax law is structured is that there are different rules in case of natural persons. So natural persons will be considered as a taxable person only if they reach a certain threshold of turnover per year. Whereas resident persons that are juridical persons are covered in more broadly manner, because here we're talking about the taxes on the corporations, as well as non-resident persons will be covered in certain situations. So when a natural person will be subject to corporate taxes? The first point you have to look when you are a natural person is to assess whether you conducted business or business activities in the UAE. So what do we mean when we talk about business? When we talk about business, we are talking about when you are exerting an activity with the intention of generating profits. And this could be either if it's a continuous activity or even if it's within a specific period. If you have the intention of generating profits, then this will be subject to corporate taxes. But the idea to give some relief to natural persons, the way that the corporate tax regime works is that we're going to assess the turnover within a calendar year. So for natural persons, we are always talking about January to December, so the Gregorian calendar year, in order to be taxed under the corporate tax. And the idea is that in order to provide further relief to natural persons, certain categories of income are excluded for this turnover. So we're going to see in further detail which amounts of income are excluded when doing this calculation. So when we are calculating the turnover for the calendar year of reaching the 1 million threshold, we are going to exclude certain categories of turnover. So salaries and wages are excluded, and this is a question you might receive a lot in practice. There was this concern whether the corporate tax would apply for salaries and wages, but the idea is not to tax these amounts of income, as well as personal investment income and real estate investment income, because the idea here is you are not running a business, so you are not with the intention of generating profit, so this shouldn't be taxed by corporate tax. So the way the registration works is that now registration is open, but for natural persons, you are only required to register if you are exerting a business activity, and only when you reach this annual turnover of $1 million per year. And here I would like to guide you with further detail when we are talking about the exclusions of corporate taxes. So this was decided in Cabinet Decision 49. And here I want to give you some explanation on what is considered as salaries and wages for the purpose of corporate tax law. So we are talking about any compensation or benefit received, whether in cash or in kind, by an employee from its employer. So the idea is that wherever it's in the contract and is considered as a compensation or benefit by its work, it was going to be considered as a salary and it's going to be excluded from this turnover, this annual turnover. Similarly, when we have the personal investment income, we are talking about any investment activity that a natural person conducts by their personal account without a license or without being required to have a license from a licensing authority. So the idea here behind, once again, is we are only taxing business activities. So if you have your own personal investment income, the idea is not to give you extra burden and tax your personal investment income. So therefore, we exclude this from the calculation of the turnover. And similarly, for real estate investment income, this was a policy decision to not burden real estate investment related activities. So whenever a natural person has and perceives income from investment, whether they're selling property or they are renting, leasing, or subleasing, if they are not required to have a license, so they are doing this for their own personal investment, this won't be taxed. So here, just to make it more clear, I would like to guide you through a few practical examples. In the first one, we have a case of a natural person. We're going to call him Mr. M, that is based on the UAE and owns residential apartments, and this person perceives an annual rental income of 2.5 million dirhams per year. And Mr. M decided to appoint a company C to manage the properties just because he is not available to manage the properties. This is not his main business. And he appointed this company to collect the rentals and to deal with the tenants for a fee. So in this case, the companies only manage the properties that belong to Mr. M. They are part of his personal investment. So the money received from Company C, from the rentals collected and perceived, and they are just managed by Company C, they won't be taxed because they're considered as part of the real estate investment income of Mr. M. Moving next, we can also have situations where a natural person, for instance, Mr. M, owns apartments together with his wife and children, and the family perceives an annual income of 2,000 million dirhams per year. And in this case, Mr. X decided to set up his own company and owns 100% of the shares together with his family to manage the properties and collects through his own personal company the rentals for a fee. And the idea is that the company here again will manage the properties and collect the rents for Mr. M, X and his family through this separate legal entity. So the idea here, once again, the money is going to be considered as real estate investment income. And as Mr. X owned 100% of the shares of Company H, the fees charged by Company H will need to be at the arm's length price. So this is another principle of the corporate tax law. When you have a payment within related parties, you have to charge an arm's length price, what would be reasonable according to the market or according to an average. Moving next, we can also have in practice cases of self-owned immovable properties. So for example, a natural person, Mr. P, owns several real estate properties, both in Abu Dhabi and Dubai, and conducts no other business. So his income derives from this real estate property he owns. And he created a sole proprietorship to manage self-owned properties. And in this case, since Mr. P holds a license to manage his real estate, the rental income will not be classified as real estate investment income. And why is that? Because for establishing the sole proprietorship, he holds a license to manage the activity. So that's the difference from the previous examples. And in this case, he will be subject to corporate tax at a rate of 9% if he exceeds the 1 million turnover from this activity. And in this case as well, as soon as he would reach the 1 million threshold, he would be required to register for corporate tax purposes. And here we can have another practical situation where Mrs. N, she's based in the UAE. She owns several properties that she rents for a total of 1.2 million dirhams that she perceived in the last calendar year. In this case, Ms. N, she has a license, but it's a license related to her bakery business. And the question would be, the fact that she holds this license would lead for her to be considered as having a license for the purpose of rental income. So here, the idea is that as long as the license is not required for the real estate activity, this won't impact on the fact that we'll consider the real estate investment as personal investment. So in this case, we won't consider for the purpose of the turnover this 1.2 million perceived per year, and we're only going to tax her under the bakery business activity if she reaches a threshold of 1 million dirhams. So now Rida will guide you through the resident persons in case of juridical persons. Thank you.
Thank you very much, Juliana. So basically, for resident person, we have certain rules related to juridical person. So Juliana, she talked about natural person, who is a taxable, considered as a taxable person in the case of natural person. I will talk on when a juridical person, so a company or a legal person, is considered as taxable person under the corporate tax law. So for resident, for juridical person, they are considered as resident person in two situations. The first situation is where the juridical person is incorporated, established or recognized under the UAE law. So incorporated means like created under the various Emirates kind of law or under the one of the licensing authorities legislation, or established by a decree or any other legal instrument. We have also the second situation is related to juridical persons that are incorporated in a foreign jurisdiction, but they are effectively managed and controlled in the United Arab Emirates. So an entity, for example, that is incorporated in Bahrain, in Oman, in Saudi Arabia, but the effective management and control is taking place in the UAE. And in that case, that person, even though it is incorporated outside the UAE and it derives its legal status from a legal system outside the UAE, because of the effective management and control, it will be considered as resident in the UAE. What does it mean, effectively managed and controlled in the UAE? Basically, the key element is that the strategic decision related to the management, related to the commercial and business decision, they are mainly prepared and made in the United Arab Emirates. So if we take a situation of an example of an entity, a parent company that is incorporated in the UAE, in year 2025, this parent company, it has 90% owned subsidiary called Subsidiary Co, which is incorporated in a foreign jurisdiction. If we have these elements gathered together, so all the key management and strategic decision related to Subsidiary Co, they are made in substance in the UAE. All the board meeting related to Subsidiary Co, they are held in the UAE. All the board member of Subsidiary Co, they are also resident in the UAE. Very likely, in that situation, Subsidiary Co, even though it is incorporated in a foreign jurisdiction, it will be considered as effectively managed and controlled in the UAE, and it will need to register for corporate tax purposes and file and comply with its tax obligation. I think this is a common situation for many groups, for many businesses in the UAE, especially with subsidiaries in other GCC countries. Now, the normal question that is kind of triggered by this situation is, if subsidiary co is considered as resident in the UAE, very likely also in the foreign jurisdiction where it is incorporated, because of the incorporation criterion, it will be also considered as resident in the foreign jurisdiction. So in that case, we have a dual residence situation, and dual residence is in general solved through double taxation agreement. So we will look at the tax treaty between the UAE and the foreign jurisdiction, and usually we have an Article 4 there. In Article 4, we have a criteria, we have a paragraph dealing with situation where a company or a juridical person is considered as resident in two jurisdictions, and then the criteria relied upon is referred to as a tiebreaker rule. Usually, it is referred to the place of effective management and control. So basically, if this company is dual resident, it will be considered as resident in the UAE because the place of effective management and control is based in the UAE. Otherwise, many treaties also refer to what we call as mutual agreement procedure between both tax authorities. So the tax authority of the competent authority of the foreign jurisdiction and competent authority of the UAE will need to decide where this entity will be considered as resident. So basically, if you have a dual residence situation, solving the dual residence will happen based on the rules available under tax treaties. Article 4, the last paragraph of each tax treaty. And tax treaties in the UAE, you know that UAE has an extensive network of tax treaties, more than I think around 118 double taxation agreements which are effective, and around 140 or 145 have been already signed in total. And then solving the dual residence will be based on the provision of the double taxation agreement. So what is the corporate tax base for resident juridical person? So basically, juridical person, they are subject to tax on their worldwide income, which means income derived from the UAE and also income derived from foreign sources from outside the UAE. And basically, juridical person resident in the UAE, they will be required, of course, to register for corporate tax purposes. If a resident company is deriving income from a foreign country, very likely this income, it has been also subject to tax in the foreign country by way of withholding tax. Then in that case, if you are a resident person, you can also benefit from the foreign tax credit if the income that you get from a foreign country has been subject to foreign source taxation. And then Article 47 of the corporate tax law allows you to benefit from the foreign tax credit if certain conditions are met. And one of the conditions is that the foreign source income is subject to tax in the UAE, and also the amount or the level of taxation of the foreign tax credit should not exceed the level of taxation that is applicable in the UAE. Again, I referred, and His Excellency referred also to the corporate tax guides. FTA also published the guide on foreign source income, and in this guide, there are a lot of examples on how to compute and how to determine the foreign tax credit based on Article 47 of the corporate tax law. Now, we talked about resident person. What about non-resident person? And here we are talking mainly about non-resident juridical person, but the rule also could be applicable for non-resident natural person. So a non-resident person for corporate tax purposes is a person who is not a resident person and he meets one of the following conditions. So to be considered as a non-resident for corporate tax purposes, one of these three situations should be met, at least. So the first one is that you should have a permanent establishment in the UAE. The second one is that you derive UAE sourced income. And the third one is that you have a nexus in the UAE, and you will be considered to have a nexus in the UAE when you have an immovable property from which you generate income in the UAE. So you have a piece of land or a warehouse that you are renting or an apartment or any property. But the nexus criterion based on Cabinet Decision 56, it is applicable only to non-resident juridical person. It does not apply to non-resident natural person. Now, what about the first criterion, so having a permanent establishment in the UAE? So permanent establishment is an international tax concept. You find it in almost all tax treaties. And under the corporate tax law, there are two types of permanent establishment. We have the fixed place permanent establishment or fixed place PE, and then we have the agency PE or the dependent agent PE. So the fixed place of business PE is a place through which a core business activity are conducted with certain degree of permanency, geographic permanency, and also permanency in time. And then we have a dependent agent PE, and a dependent agent is a person that habitually concludes contract or negotiate contract to the non-resident person. And this dependent agent will very likely, if certain conditions are met, create an agency permanent establishment for the principal who is a non-resident person. It's typically someone who is available in the UAE for a non-resident person who goes to meet client, shows the product, discuss the product, shows the the various specific technical specificities of the product, discuss modalities of payments, guarantees, all the features of the sales, and then he sends these elements to the non-resident principal, and then the principal, in that case, he will issue the invoice directly to the client in the UAE. This kind of situation could trigger, and this person will be considered as a dependent agent, and he will be considered to trigger agency permanent establishment for the non-resident person in the UAE. And then all these sales derived through that agent, they will be attributable to that agency permanent establishment in the UAE. Of course, the non-resident rules, the permanent establishment rules, they need to be read in conjunction with the relevant applicable tax treaties. So you need to read the provision of the corporate tax law in, in coordination and in conjunction with the applicable tax treaties. Also, the FTA published a guide on taxation of non-resident. The guide is quite extensive, and it talks about the various permanent establishment situation. So what is the corporate tax base for a non-resident person? Basically, in the case of a permanent establishment, we have all the income attributable to that permanent establishment. So basically, we attribute income, gross income, and also expenses to that permanent establishment, and we will determine the taxable income of the permanent establishment. If a non-resident juridical person has a nexus in the UAE, then all the income arising from the immovable property in the UAE, which is referred to as a nexus, will be taxable in the UAE. And then also we have the situation of state source income. And state source income, they are defined under Article 13 of the corporate tax law. And basically, if you have a state source income that is not attributable to a permanent establishment, it will be taxable in the UAE. It will be subject to withholding tax, but currently under Article 45 of the corporate tax law, the withholding tax rate is 0%. So in the first situation, the non-resident person will be required to register in the UAE. In the second situation, so you have a PE, you need to register in the UAE as a non-resident. You have a nexus in the UAE as a non-resident juridical person, not natural person, non-resident juridical person, so non-resident company or legal entity. You have a nexus, you need also to register. If you are only deriving state source income, you are not required to register for corporate tax, and this has been clarified by Ministerial Decision 43 related to the exception from tax registration in the UAE for corporate tax purposes. If you look at the Ministerial Decision 43 of 2023, you will see the category of taxpayer who are not required to register for corporate tax purposes, and non-resident deriving only state source income. They are listed under this ministerial decision. What are the corporate tax rate applicable to the taxable person in the UAE? So we have for natural person, if they are subject to tax, if they meet the criteria that have been mentioned by my colleague Juliana, so they have a turnover exceeding 1 million dirham in the Gregorian calendar year, then they will need to determine their taxable income. They need to register for corporate tax, and they need to determine also their tax liability based on the rates of 0% up to 375,000 and 9% above 375,000. For resident juridical person, the same also tax rates are applicable, 0% up to 375,000 and 9% above 375,000. And these rates, they are applicable to the net income. These rates are applicable to the net income, which is the taxable income. And the taxable income, as we will see later, is the accounting income adjusted based on the rules that are available under the corporate tax law. So we will basically remove exempt income. We will add back non-deductible expenses, and we will make certain adjustment in order to determine the taxable income based on the accounting income. For non-resident, also with a permanent establishment in the UAE or with a nexus in the UAE, and as I said, the nexus is only applicable to non-resident juridical person, the same rates are applicable, so 0% up to 375,000 and 9% above the 375,000 dirham of taxable income. For non-resident, only with UAE state source income, currently the withholding tax rate, as I mentioned, in the UAE is 0% based on Article 45 of the corporate tax law. Now, what about the tax period? So the tax period has been clarified in Articles 57 and 58 of the corporate tax law. The tax period is, for a taxable person, is the period with respect of which the person is required to file his tax return. So you need to file your tax return basically for each corporate tax period. And the tax period is usually the financial year or part of the financial year for which you prepare your tax return. The financial year, the principle, the default situation is that it's the Gregorian calendar year or the 12-month period for which the financial statements are prepared. And a taxable person, they may apply to the FTA to use a different tax period or to change their tax period. And this tax period could go up to 18 months and then subsequently 6 to 12 months. So the maximum period for when you change your tax period could go to up to 18 months for the first period, and then the minimum would be between 6 and 12 months. And this will be, of course, for the first tax period, or the last one if you are, ceasing to conduct business and business activities. So if we look at the how the tax period is set from a practical standpoint. So basically, for the financial year, which stretches from 1st June till 31st of May, and some taxpayer, some taxable person, they have the financial year starting 1st of June and ending 31st of May. So the first CT period will be on the 1st of June 2023. It will end on 31st of May 2024, and then the filing will need to take place at the latest by 28th of February 2025. If you have a Gregorian calendar year or a financial year corresponding to the calendar year, your first CT period will be 1st of January 2024, and then it will end on 31st December 2024, and then the filing should take place before 30 September, or at the latest by 30 September 2025. If you have a financial year stretching from 1st of April till 31st of March, many subsidiaries of foreign companies, they have a financial year based on stretching from 1st of April till 31st of March. Then your first CT period will be stretching from 1st of April 2024 until 31st of March 2025, and then you will be required to file your CT return at the latest by 31st December 2025. Now for natural person, and based on Cabinet Decision 49, the financial year will be always the Gregorian calendar year. Because the natural person, the threshold of 1 million needs to be determined based on the Gregorian calendar year. So for natural person, the first CT period will be from 1st of January 2024 until 31st of December 2024, and the filing will need to take place 9 months after 31st of December 2024, and this corresponds to 30 September 2025. So as it is mentioned here, and this has been clarified in the guide related to the taxation of natural person will always have a tax period following the Gregorian calendar year, and the first CT period for natural person will be the Gregorian calendar year 2024. So if a natural person started activity, for example, before 2024, what is before, what has been derived before 1st of January 2024 will not be considered. If you have, as a natural person, a business since 2020 or 2015, up to 31st December 2023, this will not be considered for CT purposes. First corporate tax period for natural person is the Gregorian calendar year 2024. And I think it is important to look at the corporate tax guide published by the FTA. As I said, 13 guides have been published in English. We published also many guides in Arabic. The last one published in Arabic is related to the taxation of natural person, and you have much more details and examples on these rules. So let's take an example. So Mr. Y is a UAE resident natural person that has conducted business and business activities since 2014. In the Gregorian calendar year 2024, Mr. Y total turnover exceeded the 1 million. So 2024 will be the first tax period for corporate tax purposes, and Mr. Y, he would need to register for corporate tax purposes and file his tax return and pay any tax due before 30 September or by 30 September 2025. And of course, having a turnover of 1 million does not mean that you have a taxable income that is positive, that is like a profit. You can have a turnover of 1 million, you can have also losses. But the determination of whether you need to register is based on the turnover and not on the taxable income. So if you exceed the 1 million, as explained by Juliana, and you apply the exclusion, you take into consideration types of income which are excluded for the sake of determining the 1 million turnover. If that threshold is exceeded, then you will need to register for corporate tax purposes and you need to file a tax return. Thank you, and I hand over to my colleague Zubair to talk to you about the small business relief under the corporate tax law.
Thank you very much, Rida. Good morning, everyone. My name is Zubair Chowdhury, and I will be talking to you today about small business relief, which is a very beneficial relief available to small enterprises. So let's start with an overview. What is small business relief? Well, small business relief is found in Article 21 of the Corporate Tax Law and Ministerial Decision 73 of 2023. But let's take a step back. Why do we have small business relief in our corporate tax law? Well, small business relief is provided to small businesses resident for corporate tax in the UAE to ease the implementation of corporate tax for them. Small business relief is intended to reduce the compliance burden, the compliance obligations faced by small businesses in the first few years of corporate tax, primarily by alleviating the need for them having to calculate and pay any corporate tax. As a result of claiming small business relief, other reliefs or deductions may not be applicable to those small businesses. And this means for eligible taxable persons that have elected for small business relief, they will benefit from the administrative relief, so they don't have to calculate their taxable income. Their record-keeping obligations will be slightly different, and also they will have tax relief. They will not have to pay any corporate tax if they are eligible and they claim for small business relief. And so in summary, they can be treated to elect as if they had no corporate tax due for those years in which they claim the relief. So who can claim the relief? Well, any eligible resident person who's a natural person or a juridical person can claim small business relief. And this also includes a free zone person. I'll come back to this in just a moment with the distinction between a qualifying free zone person. Now, turning to the conditions, an election is required in each period in which someone wishes to claim small business relief. And that will be made in the tax return at the time of filing, which, as Rida has just mentioned, will be 9 months after the tax period ends. And for each period, and the crucial point is this, the revenue must be equal or less than 3 million dirhams in that tax period and every previous tax period. That is the primary test if you're eligible for small business relief. And the 3 million dirham threshold applies irrespective of how long your tax period is. So Rida just mentioned there are other instances in where a tax period may be different or longer or shorter to 12 months. The 3 million dirham threshold will apply in all instances. When is the relief available? It will be available for all tax periods starting on or after the 1st of June 2023, up to and including the 31st, periods ending on the 31st of December 2026. So who cannot elect for small business relief? Well, qualifying free zone persons cannot elect. And whilst we're not going to do a deep dive into free zones today, we appreciate there are small businesses which operate in free zones. And if they wish to benefit from small business relief, they can opt out of being a qualifying free zone person and avail the benefit if they meet the other conditions to be eligible for small business relief. Secondly, members of multinational groups where the consolidated revenue is over 3.15 billion dirhams will not be eligible for small business relief. And finally, if there is artificial separation, and this was clarified by the Ministerial Decision 73, if there is artificial separation which is intended to be mischievous to claim the small business relief, then this also will not be allowable, and small business relief in these instances will not be allowable to these taxable persons. So as I just mentioned, the most important part and the most important condition is the revenue calculation. The revenue for any taxable period will be 3 million dirhams, and that will be calculated as per the accounting standards, and that will be IFRS or IFRS for SMEs. In addition to these two, you can also opt to calculate your revenue with the cash basis of accounting. So IFRS would ordinarily be calculated on the accruals basis, and the corporate tax law also allows, if your revenue is under 3 million dirhams, to calculate on the cash basis. There's also an important point on the bottom of the slide here, which is in terms of calculating the revenue, it needs to be calculated on an arm's length basis. So what does this mean? Well, if a person is interacting with a related party or a connected person, the revenue they record must be on an arm's length basis, which may differ to the amount that they actually pay to that related party or the connected person. However, documentation for transfer pricing is not required. The requirement here is simply to ensure that the arm's length standard is followed in deriving the revenue for that tax period. So what does revenue include? Well, revenue will include all the income from sale of goods or the provision of services in a tax period. It can also include the sale of assets. So if plant or machinery or any of the fixed assets in the business are sold, that will also contribute to the revenue for that tax period. If there are non-cash receipts received, so this may be barter transactions, asset for asset transactions, if any assets are received rather than cash payments, then the market value of those items will be considered to form part of the revenue for that tax period. What does revenue not include? So there's two important elements here, the first of which is VAT charged. If there is any VAT charged, as that is remitted to the FTA, that is not considered to be included in the 3 million dirham threshold. And secondly, loans or advances received. So if you take, or a taxable person takes a loan out in a specific year, they don't need to worry that that will push them over the threshold of 3 million dirhams. So let's put this into practice and go through a couple of examples here. So we have Company A, who is a UAE resident person, and we are told here that they have sales of 1.5 million dirhams. They also received dividends of 1 million dirhams. And we're also told there's operating expenses of 2 million dirhams. So what does this mean? The total revenue will be 2.5 million dirhams. So the 1.5 million from the sales and the 1 million, from the dividends, which totals 2.5 million. We're told because of the operating expenses of 2 million that their profit will be 500,000 dirhams. But we are not concerned with the profit for small business relief. This is not relevant. What's relevant is the revenue threshold, and the revenue for Company A is 2.5 million dirhams. And as such, Company A will qualify for small business relief. One of the important features to pick up from this example is that the dividends of 1 million, although exempt, because it's from a UAE company, it's still included in the calculation of revenue. Moving to a second example, so we have Mr. Y, who is operating a business. And the reason for this example is to illustrate that revenue, as mentioned, is not just relevant for the current tax period, but also relevant for all of the previous tax periods. So in the period ending the 31st of December 2026, Mr. Y has derived revenue of 1.9 million dirhams. Now, that is under the 3 million dirham threshold. However, we also need to take into account the revenue which was earned in the previous tax periods. And we are told here that in the period ending the 31st of December 2025, the revenue earned was 4.3 million dirhams, which exceeds the 3 million dirham threshold. As a result, Mr. Y will not be able to claim small business relief in 2026. We'll now go through a summary of a number of points which are relevant for small business relief and the interaction with other areas of the corporate tax law. So firstly, registration requirement. If you're claiming small business relief, will you have to register? Absolutely. Whether you make an election or not, a taxable person will always have to register for corporate tax law, as mentioned by my colleagues earlier. Will you be required to file a full tax return? No. The tax return, if you are claiming small business relief, is a simplified tax return. And that's one of the benefits of claiming small business relief. The compliance burden is lessened. Are you required to calculate taxable income? Again, no. There is no taxable income due. There is no corporate tax due. The test for small business relief is simply on revenue. If that test is met, there is no calculation needed and no CT payable for those periods. Now, interactions with other reliefs. Rida mentioned qualifying group relief, business restructuring relief, and the interactions with those other areas, you've got tax losses, tax groups, those aren't allowable if you're claiming small business relief. Tax groups can have small business relief, but that's something which we appreciate is not perhaps relevant for small businesses in this instance. In terms of tax losses for the specific year, can they be accrued or utilized in the year? No, they cannot. And the same also applies for excess interest expenditure on the specific interest deduction limitation rules that we have in the CT law. Can they be used in the year or accrued? No, they cannot. If you are claiming small business relief, they are not applicable. However, the one point or distinction to make is if these have been accrued in previous years, can they be carried forward to later tax periods? And the answer to that question is yes, they can. As I've just mentioned, reliefs for qualifying group or business restructuring transactions will not be applicable if a small business relief claim is made. In terms of transfer pricing, as I mentioned and stressed when calculating revenue, the arm's length standard must be followed, but there is no requirement to maintain transfer pricing documentation if you are claiming small business relief. The revenue threshold, which as mentioned must be relevant for the current tax period and the previous tax periods, is 3 million dirhams or less. An election has to be made in each tax return. It is not an automatic relief, and as per the last point, it is required to be self-assessed. If your revenue is lower than 3 million, there are many reasons you may not choose to adopt small business relief. Perhaps you have losses in that year which you wish to accrue, or other reasons if you wish to engage with other parts of the corporate tax law, other reliefs, other exemptions, and so this is a relief that you will have to self-assess in each taxable period. The deductible expenditure rules, which we will go on to in part 4 after the break, are not relevant, again, for the same reason as mentioned before. There is no calculation required for the corporate tax. And as such, there is no need to make deductions given that there is no corporate tax payable. Thank you very much. I will pass back to Ruther.
Thank you, Rida, Zubair, and Juliana for the valuable information. Before inviting you all to take a short break, I would like to clarify that the authority has allocated an information desk in the main hall. You can contact them and they will be more than willing to answer your inquiries and assist you with any issues related to tax and registration in the corporate tax system. We will see you back after 30 minutes. Welcome back, ladies and gentlemen. With the continuation of the upcoming presentation, we move on to the second part of our workshop for today, as we re-invite one more time our expert, Rida Hamzawi, Zubair Chaudhuri, and Juliana Candido. Please join me again in welcoming them.
Thank you very much again for your time. I think in the second part of the session, we will talk about the calculation of the taxable income for corporate tax purposes. I think we try to summarize the various features related to the computation of taxable income in one slide. Basically, we start always from the accounting income, whether it is a profit or loss. And this is based on the financial statement prepared on accrual basis, and financial statement, as we will see at a later stage, they will need to be audited in specific circumstances, mainly if the taxable person is a qualifying free zone person, or if the taxable person is having a revenue for the tax period equal to or exceeding 50 million dirham. And of course, for qualifying free zone person, the requirement to have audited financial statement is applicable irrespective of the revenue of the qualifying free zone person. So basically, the slide shows the adjustment that needs to be made to determine the taxable income. So basically, we will look at unrealized gains or losses, and this will depend on whether you have made an election to for unrealization, for non-recognition on the, of the capital gains based on realization or not, based on Article 20, Clause 3 of the Corporate Tax Law. And then you will need to make an adjustment in that case, and we'll give an example also on that. You need also adjust based on whether you have an exempt income or loss. So if you have a dividend, for example, derived from a resident company, you need to deduct that from your accounting income. You need to look at the reliefs, the various reliefs that are available under the corporate tax law. If you transferred an assets, for example, to a member of a qualifying group, the gain will not be recognized if you meet the requirement for the transfer within qualifying group. If you realize the gain also under business restructuring, Article 27 of the Corporate Tax Law, you meet the requirement for the business restructuring, the gain also will not be recognized. Then you look at the non-deductible expenditure and non-deductible expenditure that will be added back to the taxable income. You need also to consider the transfer pricing adjustment, which needs to be done for all non-arm's length transaction with related parties. So basically, you need to look at the, prepare your transfer pricing documentation and support the pricings that has been applied for transaction with related parties or connected person. And you have articles defining what is, of course, a related party and who is a connected person. You have also finally the adjustment specified in Ministerial Decision number 134, and we will talk about them. Then you have the taxable income before the tax loss relief. Then in that case, you need to check whether you have tax losses that you are carrying forward from a previous corporate tax period, and then you can offset those losses up to 75% of the taxable income of that specific year, the year for which you are determining your taxable income. And of course, pre-CT losses, you cannot offset them and you cannot carry them forward. So the losses that could be carried forward should be incurred, during a period where CT is applicable. So if your first tax period for a company under the corporate tax law is 1st of January till 31st of December 2024, the losses that you incurred in 2023, you cannot carry this forward to 2024, to your first corporate tax period. Then, once you have determined your taxable income, then you need to apply the corporate tax rate, and then you will determine your corporate tax liability. Of course, these are the standard corporate tax rate. And then if, for example, you have incurred some foreign taxes, for example, on certain items of income, you received interest from a foreign country, you have been subject to withholding tax in that foreign country, this interest income has been subject to tax at the rate of 9% in the UAE, you can claim a foreign tax credit based on Article 47 of the corporate tax law up to the a maximum amount of the CT, the corporate tax liability, applicable on that foreign source interest income. If you receive the dividend from a foreign company, the dividend is not subject to tax because it is eligible for the participation exemption, and we will see in a nutshell the requirement for the participation exemption. Then of course you will not be eligible to the foreign tax credit because that dividend is not subject to tax in the UAE. As explained by my colleague Zubair, if the small business relief is applicable when you have revenue equal to or less than kind of 3 million. This revenue needs to be determined based on the arm's length principle. And then if you elect for the small business relief, you will be deemed not to realize any taxable income. And then you will not have any CT liability, as per the condition, as I said, explained by my colleague Zubair. So if you elect for the small business relief under Article 21 and Ministerial Decision 73, then you will be deemed not to realize any taxable income. So realization basis, basically, the realized gains are, or losses are the actual gains or losses that occur on completion of a transaction. Unrealized gains or losses relate to a notional change in the value of an asset or liability without actual disposal or transfer included in the financial statement when accrual basis is adopted. In principle, based on the accrual, you will need to recognize the increase in the fair market value. But if you opt for the realization basis, then any increase in the fair market value will not be considered. And basically, a taxable person following the accrual basis of accounting, he can elect to consider gains and losses on realization basis for calculating the taxable income, either in relation to all the assets and liability subject to fair value or impairment accounting, or only to the assets classified as capital assets. So you have two ways to make this election, and this is basically explained under Article 20, Clause 3 of the Corporate Tax Law. So Article 20, Clause 3. The election for the realization basis, it needs to be done in the first corporate tax period when you file your corporate tax return. So when you file your corporate tax return for the first tax period, you need to make the election for the realization basis, and this election is irrevocable. And of course, you understand why it is irrevocable, because I think there is something in accounting called the permanency of the methods, of the accounting methods used. We cannot switch from one year to the other, from realization to unrealization or non-realization, because this will may create mismatches, and there will be leakage in the corporate tax base. An example for the realization basis: Company C, during the financial year ending on the 31st December 2025, recognized a revaluation gain on land in its financial statement of 2 million, measured at fair value. The original cost of the land was 5 million, and following the revaluation, the net book value of the land is 7 million. The land was not sold at the end of the tax period, and therefore the revaluation gain is considered unrealized, because there is no transfer of the land, there is no exchange of the land, there is no contribution in kind of the land. So the land is still with company held by and owned by Company C. In the situation where no election is made for realization basis, Company C would be subject to tax on the unrealized gain of 2 million in relation to the tax period ending by December 2025. If the election is made for the realization basis, then Company C can elect to apply the realization basis in respect of all assets and liability that are subject to fair value or impairment accounting for the company. And then in that situation, the company will not include the revaluation gain of 2 million when computing its taxable income. Then, because these 2 million have been already included in the accounting income, when determining the taxable income, you need to reduce the amount of the 2 million because of the election for the realization basis. And this is also, I think it's a very important feature, an attractive feature of the corporate tax system in the UAE, because it allows you to manage your treasury, your cash, because from economic standpoint, it's not good to pay tax on a gain that is a potential gain that has not been realized yet. What about exempt income? So here we are talking about Article 22 and Article 23 of the Corporate Tax Law. So we are talking about dividends and other profits distribution. So dividends received from a UAE company are exempt from corporate tax without any condition. So a UAE company that is paying a dividend to another UAE company, at the level of the recipient entity, the dividends are exempt from tax. without any condition. And here we are in a pure domestic situation. If a UAE company is receiving dividends from a foreign juridical person, those dividends, they will be also exempt from tax, subject to meeting the requirement under Article 23, Clause 2 of the Corporate Tax Law, meaning the participation exemption requirement. If the participation exemption requirements are met, then foreign dividends will be exempt from tax in the UAE, and those dividends, they will not be taxable under the corporate tax law. So in the first situation, we are talking about a domestic situation, UAE company paying a dividend to another UAE company. This is a domestic situation, and at the level of the recipient company of the dividend, there is an exemption without any condition because it's a domestic situation and the dividend is paid between two resident juridical persons. If we are in a cross-border situation whereby a UAE resident company is receiving dividend from a foreign entity, those dividends could be exempt from tax if the participation exemption requirements are met. And the participating interest requirement, mainly, it means a 5% or greater ownership interest in a juridical person held or intended to be held for an uninterrupted period of 12 months. Or if the historical acquisition cost of the ownership interest is at least 4 million dirham. So you need to have either 5% of the share capital of the participating interest of the subsidiary, or if you don't have the 5% in the share capital, you need to have a minimum of 4 million of acquisition costs. So basically, because we consider that 4 million is a substantial amount, so we also apply the participation exemption. If you have those requirements, and these requirements are more detailed under Article 23(2) of the Corporate Tax Law, and also under the Ministerial Decision 116 related to the participation exemption, then the following types of income, they are not taxable or they are exempt from tax. So either are not taxable or not also deductible. So dividend and other profits distribution, gains and losses from the disposal of the shares, and also foreign exchange gains and losses, and impairment gains and losses. These types of income, they will not be considered for corporate tax purposes. And of course, the provision of the exempt income when we are in a situation where the small business relief is elected, these conditions, they would not apply because the entity applying for the small business relief or the person applying for the small business relief is already deemed not to realize any taxable income. So it's not useful to opt for these, to claim this exemption, because you are deemed already not to realize any taxable income. In general, also the expenditure that is related to an exempt income, other than interest, is not deductible. So if you incur some expenditure to get a taxable income, this expenditure is in general deductible. If you incur expenditure for the purpose of realizing an income that is exempt from tax, we treat this kind of in equal manner, and we will deny the deduction of the expenditure, because the income generated from this expenditure is also not taxable because it is exempt from tax. So if we kind of summarize the participation exemption, and in previous session we had a lot of slides on participation exemption, but it's quite, I would say, sophisticated, so we wanted to summarize it and try to simplify it a little bit. So the parent company in a UAE hold a participation of 10% in another company, a subsidiary called Participation Co. The income in that situation is exempt without the need to meet any condition. And here we are talking only about a dividend. The dividend is exempt without, irrespective of any condition, between two resident companies. The same thing if we are in a domestic scenario, but in that case, parent co is realizing capital gains on participation co. In that specific situation, because we are dealing with capital gains and not with a dividend, so basically parent co will transfer the participation in participation co and then realize some capital gains. In that case, the capital gain will be exempt from tax if the participation exemption requirements are met. So in a domestic scenario between two resident companies, dividends exempt without any condition, capital gains, they are subject to the participation exemption rules in order to meet the exemption requirement. This is for a domestic scenario. If we are in a cross-border scenario, then the dividends or the capital gains, both of them, they will be exempt from tax at the level of the parent company, which is resident in the UAE, if the participation exemption requirements are met, whether we are talking about dividends or capital gains. This is a point that is extremely important under Article 22 and other Article 23 of the Corporate Tax Law. And also it has been clarified under the Corporate Tax Guide related to the participation exemption. The FTA published an extensive guide on the application of the participation exemption rules, and I think you will find much more details there with example on each of the requirements that need to be met in order to claim the participation exemption. But we try to summarize these in these two slides. Okay? The requirement related to the holding the participation for 12 months or the intention to hold the participation for 12 months is a sort of an anti-abuse clause, because we don't want a situation where you have less than 5% of the share capital of the subsidiary, or you have less than 4 million in value of participation, and then just before the distribution of the dividends, you will try to go and buy more of in the share capital just to meet the requirement of the 5% or the 4 million at the time of distribution. And then you claim the participation exemption, and then you sell back this participation. So this is kind of the abusive scheme, why the intention to hold the participation or the requirement to hold the participation for 12 months was introduced in the law, and it's based on international standards, based on, it's one of the rules that were introduced under the BEPS, base erosion and profit shifting reports of the project of the OECD. And this requirement at the end also, it was also introduced under the OECD model in 2017 based on the BEPS report on Action 6 related to treaty abuse. So they added the requirement that in order to get reduced withholding tax rate on dividends, you need to hold the participation for 365 days, which is 12 months. We have other reliefs available under the corporate tax law. The transfer within a qualifying group. So basically, This is a corporate tax relief that is available where an assets or liability is transferred at a net book value between members of the same qualifying group, which allows the transfer to take place without giving rise to a corporate tax liability. If certain conditions are met, you transfer an asset to a member of the same qualifying group, then you can transfer this asset at net book value, and then no capital gains will be realized. There is another regime, also another relief that is available under Article 27 of the Corporate Tax Law, which is the business restructuring relief. And of course, what is meant by business restructuring is typically merger, spin-off, and then we have the condition under Article 27. If those conditions are met, basically the transfer and the restructuring will be considered to trigger no gains or losses. So where entire business or independent part of a business is transferred in exchange for shares or other ownership interest, business restructuring relief may apply to eliminate the corporate tax impact of these transactions. And of course, this article is meant to encourage corporate restructuring, which is a very important feature in a corporate tax system. And more guidance will be provided on these two regimes in the future. And as mentioned by my colleague Zubair, if you claim or you elect for the small business relief, the transfer within qualifying group and the business restructuring relief, they will not be available because, again, under the small business relief election, you will be deemed to not to realize any taxable income. Now, what about the deductible and non-deductible expenses? So the general rule is that for deductibility of expenses, which is applicable across the board to all kind of expenses, is that the deductible expenses should be incurred exclusively for the sake of the business. If an expense is incurred for more than one purpose, the portion determined to be incurred for business purposes, only this portion will be deductible. Expenses generally will not be considered as deductible if they are not incurred for business purposes. If a company will spend on the holidays, for example, of the owner, this is not an expense that is considered as incurred for business purposes, then this will not be considered as deductible. If the expense is related to an element that is capital in nature, so that the expense should be capitalized and for the purpose of creating or developing an assets. If the expense also is incurred for the purpose of deriving an exempt income, also it will not be deductible. Also, losses which are not connected or arising out of the business, also those losses, they will not be considered as deductible. There are specific rules that are related to the interest expenses, and the deductibility of interest expenses is subject to the general interest deduction limitation rule. And basically, here again, the law uses another element that has been stated by the OECD Base Erosion and Profit Shifting Project, which is the EBITDA criterion, and then the amount of the maximum interest deduction will be capped at 30% of the EBITDA. And there is also a ministerial decision that specified the condition for the application of the deductibility of interest expenses. The EBITDA rule, of course, we have a sort of a de minimis requirement. The EBITDA rule will be applicable if the net interest expenditure exceeds the 12 million dirham over the specific tax period. And the net interest expenditure is the difference between interest incurred by the business and interest received by the business or generated by the business. So we look at the net interest expenditure and we apply the EBITDA rule and the 12 million threshold for the net interest expenditure, and not only for the gross amount of interest that are incurred by the business. We need always to look whether the business has also received interest and determine always the net interest expenditure. For the entertainment expenses, 50% of the entertainment expenses only will be deductible, and this will include meals, accommodation, and transportation. 50%, the other 50% needs to be added to the taxable, to the accounting income for the sake of determining the taxable income. For donations and gifts, so only donation paid to qualifying public benefit entities will be deductible. Donation paid to any other person, they will not be considered as deductible expenses, and they will not be considered as deductible for corporate tax purposes. Qualifying public benefit entities, the list of these entities has been published by Cabinet Decision 37 of 2023. A very important element also that was mentioned by my colleagues is related also to transfer pricing. So when we talk about a deductible expense, we are talking about an arm's length expense. So if this expenditure is charged by a related party, the amount of the expenditure should meet the transfer pricing requirement, and it should meet also the arm's length principle. And then, for example, this would apply to interest expenditure. So if you are incurring interest because those interests have been charged to your company by a related party, or so a related company, parent company, or any person that is fit into the definition of a related party, then you need to consider that this should correspond to an arm's length amount. And then, of course, you apply the caps for the interest limitation based on the EBITDA and the 12 million de minimis rule. So expenses that are deductible or non-deductible based on certain situation. We took some example of specific expenses. So fines and penalties. So basically, if you incur fines or penalties for the compensation, or you pay them to compensate the damage or breach of a contract, these will be deductible. Any other fines or penalties for the infraction of the law, they will not be considered as deductible expenses. Bribes, illicit payment, they are non-deductible. Dividends and other profit distribution paid to the owner of the taxable person, they are not considered as deductible. Amounts that are withdrawn from a business by a natural person who conducts business in the UAE, or a partner in an unincorporated partnership, also they are considered as also non-deductible expenses expressly by the black letter of the law. The corporate tax itself is a non-deductible also expense, and input VAT, for example, the irrecoverable input VAT is considered as a deductible expense. What you recover as input VAT will consider it as non-deductible. And of course, again, if you elect for the small business relief, because of the revenue of a maximum of 3 million, this rule, they will not apply because you will be deemed not to realize any taxable income. So you see to which extent the small business relief is a very kind of beneficial and attractive regime, because it simplifies the compliance requirement. It simplifies also, it relieves you from any corporate tax burden. Transfer pricing rules. So basically, the transfer pricing rules, that they are meant to ensure that the pricing of transaction is not affected by the nature of the relation that you have between the parties that are involved in that transaction. And the feature or the condition for the transaction between related party, it should be consistent with those carried between independent person or non-related person. The FTA, it has the right to adjust the price of non-arm's length transaction. And if you look at the slide on the tax return, you will see on the determination of taxable income, you will see that there is also a statement related to adjustment for our non-arm's length transaction. And this is also reflected in Article 20 of the corporate tax law related to the determination of taxable income. So basically, for the sake of determining the arm's length price, to meeting the arm's length price, specific methods, they are applicable according to the facts and circumstances of the taxpayer, according to his activity. The FTA published a comprehensive guide on transfer pricing. I think it was published 4 or 5 months ago, one of the first corporate tax guides. And I think, of course, for a business that elect for the small business relief, you are not required to to comply with transfer pricing documentation, but you need to comply with the arm's length principle. So for example, if you have an entity, the entity is conducting transaction mainly with a related party, and you kind of adjust the prices for that entity in order to remain below the 3 million threshold. The FTA, if they see that your transaction with a related party, they should be priced at a higher, they should be charged, a higher price should be charged, they can reassess the pricing based on the transfer pricing rules and determine that your revenue is exceeding the 3 million threshold, and then you will not be eligible for the small business relief. And this is why my colleague Zubair referred, when describing the condition or talking about the condition for the small business relief, to the 3 million. The 3 million should be an arm's length threshold and not just a figure of gross revenues derived by the taxable person claiming the small business relief. There is a very important provision in Article 34 of the corporate tax law also, which is related to corresponding adjustment. So what is a corresponding adjustment? Basically, that is made to the taxable income of, based on the adjustment made to the taxable income of a related party or to another related party. You have 2 types of corresponding adjustment: domestic corresponding adjustment and a cross-border corresponding adjustment. So domestic corresponding adjustment, basically, if you are conducting transaction between 2 related parties, both of them are resident in the UAE, and one of these parties has been subject to a transfer pricing audit, transfer pricing adjustment by the FTA, and the FTA decided that the price should be adjusted, increased or decreased based on the arm's length principle. The other party to the transaction should also be eligible to a corresponding adjustment. If there was an increase on one side, there should be a decrease on the other side. And this is meant to avoid what we refer to as economic double taxation. The second situation for corresponding adjustment is a cross-border situation. So the same adjustment is happening. So a taxpayer in a foreign country, you are conducting a related party transaction with that taxpayer, which is based in a foreign jurisdiction. And then this taxpayer has been subject to a tax audit in that foreign jurisdiction, which is affecting the overall tax burden on the transaction. In that case, the corporate tax law allows you to claim a corresponding adjustment, but in that case, it will be subject to an application. In the first situation, in domestic situation, it is a systematic corresponding adjustment because both taxpayers are based in the UAE. Both of them are UAE corporate taxpayer. In the second situation is a cross-border situation, so the taxpayer that is based in the UAE can come apply to the FTA for a corresponding adjustment based on the adjustment that happened in the foreign jurisdiction. And also the corresponding adjustment, again, to mention that it's a provision that is available also under most of double taxation agreement of the UAE. You will see it under Article 9, Clause 2 of the most of tax treaties. And Article 9, Clause 2, Article 9 itself, it refers to associated enterprises. So this rule also is available under tax treaties or double taxation agreement. What does it mean, a connected person? Basically, a connected person, I think the definition is available under Article 35 of the corporate tax law. So it's a natural person who directly or indirectly has an ownership interest in or controls the taxable person. Could be also director or an officer of the taxable person. Related party to the owner, director, or officer of the taxable person. Also partner in an unincorporated partnership, they will be considered as also connected person. Payment or benefit provided to connected person are deductible to the extent they correspond to the market value and that they are incurred wholly and exclusively for business purposes. And the condition that the expense is incurred wholly and exclusively for business purposes is a general condition that is applicable to all expenses before even reaching whether the transaction or the expense is charged at arm's length or not. And then the control, it means the ability of one person to influence another person, including 50% or more voting right, 50% or more composition of board members, or receiving 50% or more of the profit, or influencing the conduct of the business and its affair. And the last point, it will be based on facts and circumstances and the specifics of each situation. The definition of related parties, so you can see the definition. So basically it includes two or more natural persons related within the fourth degree of kinship. It includes also natural person, juridical person, where the natural person directly or indirectly controls or owns 50% or more of the share in that juridical person. So if you have a person that owns with his related party, with his wife, for example, and children, more than 50% of a company, of a juridical person or a company, then all the transaction between that person and that company should be subject to the arm's length principle. You have also other situations where one juridical person directly or indirectly controls or owns 50% or more of the share of another juridical person, or where a third juridical person controls directly or indirectly or owns more than 50% of two or more juridical persons. Then these two juridical persons owned by, more than 50% by a third person will be considered as also related parties. A permanent establishment and and the head office will be considered as also a related party. A UAE juridical person or a UAE person with its foreign permanent establishment, also they will be considered as a juridical person, as related parties. Partners in a UP, also they are considered as related parties. And then the meaning of control is somehow the same. What is a tax loss relief? So this is also, it's an important feature of the corporate tax law. So if a taxable person deductible expenditure exceeds the income that is subject to corporate tax, they will have a negative taxable income, i.e., which means a tax loss. Tax loss can be also carried forward and used to reduce future tax period up to a maximum of 75% of the taxable income of that subsequent tax period. Unutilized tax losses can be also carried forward indefinitely if 50% or higher in terms of ownership interest is constant from 1 year to the other, or if there is a change in the ownership, if the taxable person continue to conduct the same or similar business or business activity. So basically, from 1 year to the other, you can carry forward tax losses. Is there a time limit for the carry forward of tax losses? No, there is no time limit. Usually in many jurisdictions, you can carry forward tax losses up to 3, 4, 5 years. The corporate tax legislation in the UAE is quite generous. It allows for an indefinite timeline in terms of carrying forward tax losses. The only condition here is a condition that is related to the amount of the losses that you can claim. So you can carry forward tax losses up to 75% of the taxable income of the year in respect of which you claim, of the taxable income of the year in respect of which you claim those losses. Also, there is a requirement to maintain the same ownership, to maintain 50% at least of the same ownership from 1 year to the other. If not, if the requirement of maintaining 50% of ownership is not met, then still you can still carry forward tax losses if the taxable person has continued to conduct the same or similar business activities. And then I think I mentioned this in the past, so losses, tax losses that are incurred before the commencement of the corporate tax law, they are not eligible for relief. You cannot carry them forward. Losses also that are incurred before a person becomes a taxable person, they are also not eligible for the carry forward. And this is, for example, a situation where, for example, 2024 tax period, a person is an exempt person. And then he incurred losses. And then in 2025, he does not meet anymore the exemption requirement. Then the losses incurred in 2024, he cannot carry them forward for 2025 because in 2024, he was not a taxable person. He was an exempt person. Also, assets and activities which generate exempt income, those also you cannot, claim losses on those kind of activities and assets. Let's take an example on the tax loss relief and the carry forward of tax losses. So basically, you have parent company owning 100% of a subsidiary company. And in year one, which is a period in which the corporate tax law is applicable, so the subsidiary company has a tax loss of 1,000 in year one and a taxable income of 200 in year two. The tax loss relief and carry forward of tax losses is illustrated here. So basically, in year two, you have a taxable income of 200. You can claim, you carry forward your tax losses from year one up to 75% of the taxable income of year two, which is 200. 75% of 200 is 150, and then you can claim up to 150 of these tax losses, and then the balance is 50. Then you are left from year one, you are left with still 850 of tax losses that you couldn't claim in year 2. These tax losses, they are eligible to be carried forward for year 3 and 4, etc., subject to the requirement that at least 50% of the ownership in subsidiary company is not changed. Or if more than 50% has changed, you need to maintain the same activity or similar activity. So here, parent company, for example, in year 2, they sold 30% of the participation to another company, to a buyer company. Here we have still the 50%, maintaining the 50% of ownership. This criterion is met. So the company can enjoy the carry forward of losses. If the parent company would have sold, for example, 70% or 80% of the participation, and if the company, the subsidiary company, would have changed completely its activity, then those losses, the 850, they would not be able to carry them forward for the following tax period. Again, the corporate tax regime, as I said, is quite generous for the carry forward of tax losses because there is no limitation, the limit in terms of time. The limitation, they apply only to the amount of losses, and they apply also in respect of the condition for claiming the tax losses carry forward. Thank you, and I leave the floor to my colleague Juliana to talk about compliance requirement with respect to the corporate tax law.
Thank you, Rita. Hi, everyone. So in this part of the section, we would like to briefly guide you through some of the important points after calculating the taxable income. So we are going to see which other kinds of obligation taxpayers need to follow. So first, with respect to the accounting standards, the UAE decided to follow accounting standards that are largely accepted by other countries. So the choice was to apply IFRS. So the IFRS that are used largely across the globe are also applied by the UAE. And the exception is that for business with a revenue less than 50 million dirhams, IFRS for small and medium business can be applied, which are quite simplified, so it's easier to apply for these cases. And in order to calculate the accounting basis, normally taxable persons have to follow the accrual basis, so when the expenses are incurred. But as Rita mentioned, one of the benefits of the corporate tax regime is that an election for realizations basis can be made, and this can be helpful for your treasury. Another exception is that a business can follow the cash basis of accounting in case of revenue less than 3 million dirhams per tax period. And in exceptional cases as well, taxpayers can submit an application to the FTA explaining why they would need to follow a cash base of accounting. Another administration requirement is to register, and as His Excellency mentioned, registration is already open, and we encourage and we urge you and your clients to register as soon as possible in order to have a smooth process. And the timeline is that you should register before the first filing, but we really encourage to register as soon as possible. And it's all done online via the Emiratex portal. And as we mentioned, we also have a support and a registrations team that can support you in case of specific questions or issues. And the idea is that now, even if you are a natural person, if you are, as mentioned, if you are above the 1 million turnover, then you would also need to register under the Emiratex. So it's important to have this in mind. And as my colleague will mention afterwards, Zubair, we are open to answer private clarifications, but one of the requirements is that you are registered for CT purposes. And briefly, I'll talk about the deregistration. It's also made under the Emara Tax portal, and in case a business needs to deregister because, for instance, they have closed their activities, then it's required that the business is in line with all the administration requirements. So it's a requirement that 3 months after the cessation of business, you pay all the final corporate tax due and you file all the pending tax returns in order to be deregistered from the system. About the tax return, so we have a timeline of 9 months after the relevant tax period to file the tax return, and this is slightly different from the practice from VAT, that for VAT purposes you have to calculate and pay the VAT due as soon as possible, as soon as you have your computation, but for corporate taxes, you have this period of 9 months. In the beginning of the presentation, we saw the different tax periods, and regardless whether you have a January to December period or a different tax period, you have these 9-month periods to do your calculation, to find the tax return, and then to pay the amount of taxes due. And the tax return is going to be completely online, and it has to include the information that is here in this table. The first 3 categories, so the tax period, the name and address, the tax registration number, and the date of submission, these are pre-populated. But for the other points, you need to keep your accounting standards and have your accounting calculation, and you have to populate this information in the system, which is the accounting basis, the taxable income for the tax period, which you have calculated based on the accounting standards, the amount of tax loss relief claimed, if applicable, the amount of tax loss transferred from or to group members, the amount of tax credit claimed, if any, and the amount of corporate tax payable for the period. So applying all the reliefs and all the adjustments that Rida mentioned that are available in the calculation, then you would reach to the amount of corporate tax payable. And in terms of currency, we know that here in the UAE, there are many multinational business or business that have operation in other countries. But for the purpose of the tax returns, you have to submit the amounts in dirhams. So in case you need to do a conversion, we're going to follow the exchange rate set by the central bank. And there are 3 different types of exchange rates possible. We would first aim to apply the spot rate on the date of the transaction. But if it's not practical, it would be acceptable an average, either the monthly average exchange rate, or if it's not possible, the average annual exchange rate. But always we have to file the tax return using dirhams. And in terms of documentations, normally business have to keep documentations, and the documentations are generally specified under the tax procedure law. But it's important to state that the specific requirements for corporate tax purposes follow the corporate tax law. So for corporate tax law purposes, business need to maintain financial statements, and it's important that in this year before the filing period, business are regularizing their documentation, and in case there's any issues or they were not keeping documentations, they have this period before the filing period to arrange their documentation. And in case, as I just mentioned, in case you have a revenue that does not exceed 3 million dirhams per year, it can be used the cash base of accounting. Whereas in the case of large business, multinational business, that the revenue exceeds 50 million dirhams, audited financial statements are required. So the scrutiny is higher in these cases, and they need to prepare audited financial statements. And of course, when the taxpayer is filing the tax return, it doesn't have to submit the financial statements, but if the FTA requires so in the course of an audit or in case of additional questions, business need to be ready to show their financial statements. And another obligation in terms of the documentation relates to transfer pricing. And as Rida mentioned, transfer pricing is applicable in the UAE under certain circumstances. And in these cases, the relevant taxpayers need to have the disclosure of the information. So the way it's going to work is that in the tax return, certain category of business, such as qualified free zone persons and large business, they will have to complete a TP disclosure form. So certain related parts transactions will have to be specified in this transfer pricing disclosure form. And as well, the FTA may require additional information and additional documentation that supports that the arm's length price was applied when there were related party transactions. And finally, the record-keeping period for CT purposes is 7 years. And this is important to stress because under tax procedure law, the standard period is 5 years. But for corporate tax purposes, you are required to keep documentation from 7 years after the end of the relevant tax period. In terms of payment, the due date is in line with the preparation of the tax return. So the corporate tax due needs to be settled after 9 months of the relevant tax period. So you have these 9-month periods to submit the tax return and to pay the amount of corporate tax due. And with respect to refund, refund can be available only in 2 circumstances for corporate tax purposes, which is when you have a withholding tax credit available that exceeds the corporate tax payable. But we don't foresee this in the first few years because, as you know, for the moment, the withholding tax is rated at 0%. But there might be cases as well that the tax payable person has overpaid corporate taxes, so they would be eligible to a refund, which will be also done via the system. And finally, I just would like to show you the penalties that are might be incurred in case of the violation of the corporate tax. I'll leave you take a picture. So here you have the administrative penalties. For instance, in case of failure to maintain or submit the necessary data, records, and documents, failure to submit the tax return within the time frame. That's why we urge business to register in advance to avoid issues and delays in submitting the tax return. Also, submitting an incorrect tax return or failing to submit the registration within the applicable time frame that we just saw, it's within 3 months of the end of the activity. Failure to settle the payable tax within the time frame, or failure to submit a voluntary disclosure when there was errors in the tax return or in the tax assessment. And finally, failure to offer facilitation to the tax auditor. So that's why it's important always to have the documentation up to date and available in case of audit, and any other violations that might be specified in the future. And the amount of the penalty would not exceed 2 times of the amount of tax in respect of the assessment issued. And now we're going to finally guide you through the private clarifications. Thank you.
Thank you. Thank you very much, Juliana. So I'm going to spend just a minute or two talking about private clarifications. The private clarification process is something that the FTA is allowing and offering to taxpayers, taxable persons in the UAE, and it's very useful if you have any queries. As we have seen today, even for small businesses, we appreciate corporate tax can be complex. And if you have any questions, the private clarification is the route to allow for you to gain certainty. We appreciate that taxpayers want certainty in the transactions that they are entering, in any proposed transactions that they are doing in the next year or beyond that. So what is a private clarification? A private clarification is an official response that the FTA provides in relation to a tax query on the tax treatment of specific transactions. And there's a few points which I'd like to go over, which are very important, as the clarifications have opened for corporate tax, and we have started to receive clarifications, and we have encountered some issues. So hopefully this slide in the next couple of minutes will provide some insight into avoiding those issues if you are submitting private clarifications. So let's start with, how do you apply? If you have a query, if you have a question, you want to gain certainty, how do you submit a clarification? It's done through the Amara tax platform. So as an applicant, you'll be able to file your private clarification online. We do have a user guide which is available online also, which can guide you through that process. And in the coming year, in 2024, we will also be updating the relevant guides for private clarifications. So who can submit a private clarification? Well, we are accepting private clarifications from people who are registered for corporate tax. As my colleagues have said, His Excellency started off this presentation this morning. We urge you to please register. If you are registered, you have access to the private clarification process. The only exception to that will be if your clarification is in reference or in relation to whether you need to register or not. In that instance, then we are able to respond to your private clarification request. In regards to submitting the request, there must be an interest in the matter for the applicant. It can't be about someone else or a third party. It has to be about the applicant making the private clarification. If there are questions which are about a related party, perhaps a spouse, perhaps another company which you may have an interest in, unless it is about that specific taxable person, we will not be able to answer that clarification. And that makes me turn to the final column, which is the reasons for rejection. So as we have started the private clarification process, there are sadly some instances in which we have to reject these private clarifications. So the first point is there's no genuine legal uncertainty. The whole point of having the private clarification process is to gain that uncertainty. If there is no uncertainty to begin with, if the point is clear from the legislation, from the CT law, the decisions, and there is nothing for us to add, then this would be rejected in terms of the process, and it's something that we wouldn't be able to provide a clarification on. And the next point is the form being incomplete, and I can't stress this enough. If you are submitting a private clarification request, please ensure that the form is complete. This will be around details, transaction, documents, everything that is relevant to the private clarification. Please ensure this is uploaded. If we have everything, we can respond with the private clarification. However, if the information is either not there or it's unclear, then we may have to reject the request. The next point is the technical or legal analysis. So when you are submitting a private clarification, there's also a point where you enter your position, your technical analysis, your legal analysis of the matter at hand. And that's something that we require. The private clarification process isn't something where we're essentially offering advice. We are offering a clarification. We are clarifying either your point of view or explaining the position from a corporate tax law perspective. So please ensure that you are providing the technical and the legal analysis when submitting your private clarifications. If we suspect that there is tax avoidance, then that is something we are not able to provide a clarification on. If that's the FTA's perception or point of view, the clarification will be rejected. And once again, if it does not relate to the applicant, that's not something that we can answer. So please ensure, we appreciate that there may be different relations, but it's crucial that it has to be the taxable person to which the clarification relates is the one who's making the application. And to wrap up, how long does it take for our response? Well, we have our internal checks and processes to do when providing the clarification and to ensure there's consistency across all our messaging. We will take 50 business days to respond from the date of receipt or when final or further information is provided by the taxpayer. And another brief point to note, if there is a matter on tax residency, the process for tax residency should be gone through the TRC route and not a private clarification. If we do receive something in relation to our TRC or to establish residency, that's not something that we can accept through the private clarification treatment. Thank you very, very much for listening to me about this. I will hand back to Ruda. We have concluded for the slides for now, but we will have some Q&A, I understand. Thank you.
Thank you so much, Rida. We now move to an important part of today's agenda. We will be gladly responding to your inquiries and questions about corporate tax. When registering for this workshop, many of you asked questions, and our team of experts will answer all the questions raised. So join me one more time as I join our tax policy expert in tackling these questions. Hello once again. So first question goes to Juliana. Is corporate tax registration mandatory if you are already registered for VAT?
Thank you, Ruda. Indeed, even if taxable person is already registered for VAT purposes, it still has to be registered for corporate tax purposes. First, in practical terms, because the TRN is different, so in FTA, if you are registered for VAT purposes, you have one TRN, and once you register for corporate tax purposes, you have a different TRN. So any juridical persons need to register for corporate taxes, and natural persons, once they reach the turnover of 1 million dirhams, they also have to register for CT purposes.
Thank you, Juliana. What about how can a sole proprietorship register for corporate tax?
Thank you for this. Yes, this is a recurrent question. So a sole proprietorship is considered as the natural person behind for corporate tax purposes. So in this case, once again, if the sole proprietorship reaches the 1 million dirhams threshold, it will have to register for CT purposes.
Thank you so much. Rida, if a natural person started in 2024 a new business through an LLC, where he owns 100% of the capital, single owner LLC, should the natural person register for corporate tax purposes?
This is a very good question. It's a recurrent question, actually. The person who should register in that situation is the LLC. The LLC is juridical person. It should be registered for corporate tax purposes, irrespective of the level of revenue, because it is considered as taxable resident person, juridical person incorporated in the UAE, including a free zone company. So the person who should register in that case, not a natural person, but the LLC. And even though the LLC is 100% owned by one natural person, so it's a single owner limited liability company, it is considered as a separate juridical person, and then the LLC should register. The natural person, if he's conducting business or business activity exceed 1 million threshold, 1 million revenue threshold in a Gregorian calendar year as per Cabinet Decision 49, then he will be required to register. If this requirement is not met and the business activity is not conducted, then no threshold is crossed over a Gregorian calendar year, and then he should not register. But I think it's an important point because there are a lot of, for small businesses, a lot of confusion between a natural person and the juridical person held, especially LLC, held 100% fully owned by a natural person. So it's a separate juridical person, and the juridical person should register, the natural person no in principle, unless he meets the requirement of Cabinet Decision 49.
Thank you so much, Rida. Fourth question goes to Zubair. Should taxable income be calculated based on audited financial statement only?
Thank you. So taxable income needs to be calculated starting from the accounting income, and that is considered from IFRS or IFRS for SMEs. And in certain instances, as we've seen today, the cash basis. Now, in terms of the audited financial statements, that's only applicable once the revenue exceeds 50 million dirhams or it's a qualifying free zone person. So one of the requirements to be a qualifying free zone person, or one of the conditions I should say, is to have audited financial statements. So all persons are required to use accounting income as their starting point, adjusted to reach their taxable income as was seen today in part 4 of the presentation. But audited financial statements are only for qualifying free zone persons and those who have revenue exceeding 50 million dirhams in a tax period.
Thank you, Zubair. One more question for you. Is a non-resident having PE in UAE required to prepare financial statements as per IFRS for corporate tax purposes, even if it otherwise follows a different accounting standard?
So I can take this question. So basically, if some branches of foreign companies, they are preparing their financial statement based on a different accounting standard. It's the accounting standard usually of the head office jurisdiction. In that case, despite the fact that they are preparing their financial statement based on another accounting standard, for the purpose of the corporate tax in the UAE, they should prepare the financial statement as based on IFRS if they exceed the 50 million, or IFRS for SMEs if they are below the 50 million. Basically, if they are also establishing a free zone, they need to use IFRS irrespective of the level of revenues, and the non-resident person with a PE in the UAE is considered as taxable person, so the obligation of using or relying on the accounting standard applicable in the UAE is also applicable to them. Okay?
Okay, thank you so much, Rida. What about if a natural person's taxable income does not exceed 1 million dirhams? Are they required to register and file a tax return?
So if a natural person taxable income does not exceed 1 million, I think we should be careful here because the requirement or the threshold for natural person is 1 million, but it's based on the revenue, not on the taxable income. So if the revenue exceeds the 1 million, then in that case, they will be required to register, and the revenue should be determined and considered over a Gregorian calendar year. So basically, we need to look at the revenue and not at the taxable income. But in general, except few situations, in general, if you have a taxable income of 1 million, it means in general that you have revenue exceeding the 1 million. But again, for natural person, we don't look at the taxable income, we look at the revenue, and for the purpose of determining whether the revenue exceeds 1 million or not, we consider excluded also activity. They should be excluded, they should not be considered. So the one mentioned by my colleague Juliana, wages and salaries, real estate income, private investment income, those should not be considered. And then if over Gregorian calendar year, from January till December, you have more than 1 million of revenue, not taxable income, then you will be required to register. So I think it's a good question, and sometimes it's confusing. So again, the criterion for natural person is the revenue and not the taxable income.
Thank you so much, Rida. Juliana, can an owner of sole proprietorship pay themselves a salary and deduct it as an expense?
Thank you, Ruda. So the sole proprietorship here will be considered as a natural person, and we consider that a natural person cannot remove this amount from the business. So the salary will be considered as taking out of the business, and it won't be considered as a deduction for the purpose of calculation of corporate taxes.
Thank you so much. This question goes to Zubair. Should taxable income be computed only in AED?
Thank you. Yes, it should be. And when accounts are not prepared in dirhams, then as Juliana mentioned before, they need to be converted into dirhams. And FTA Decision 11 of 2023 stipulates how this should be done. So ideally, we would use the spot rate for that specific transaction. If that's not practical, then you would use the monthly rate. If that's not practical, you would use the average annual rate. Now, when considering which rate to use, you need to give consideration to what type of business, what transactions you are doing. So it's not something which you can automatically go to the average annual or the monthly. You need to make some considerations and make an effort to do the most accurate transaction conversion possible. And the FTA will consider this when receiving those conversions which are made in returns. So yes, and if they're not in dirhams, then they need to be converted as per FTA Decision 11.
Well noted. Thank you, Zubair. Rida, are exports of goods and services subject to corporate tax?
So exports of goods and services, I think the person who asked this question is very much kind of more familiar with VAT. So for corporate tax purposes, the exports of goods and services are in principle subject to corporate tax because for corporate tax purposes, we determine what is considered as taxable income is basically the worldwide income. Income from the UAE and income from outside the UAE. Now, there could be situations where the exports or the proceeds or the income derived from the exports of goods and services is not subject to corporate tax or subject to a zero rate. Basically, if you elect for the small business relief and then you meet the requirement of the small business relief, which means that you have within these 3 million of revenue some income that is derived from exports of goods or services, then you will be deemed not to realize any taxable income. If you are a qualifying free zone person and the exports of goods and services are somehow considered as qualifying income that is eligible for the 0% rate according to Article 3, Clause 2 of the Corporate Tax Law, then also in that case the income will not be subject to tax or will be subject to a 0% corporate tax. Also, if you have a foreign permanent establishment and you are electing for the foreign PE exemption under Article 24 of the Corporate Tax Law, then in that case also some income derived from the exports of the goods and services, if they are attributable to that foreign PE, you elect for the foreign PE exemption, then also these proceeds, these income derived from these sales also will not be subject to corporate tax based on the foreign PE exemption.
Thank you so much. Will depreciation of an asset be deductible expenditure? If yes, are there separate depreciation rates for corporate tax purposes?
Thank you. So basically the depreciation of an asset is a deductible expenditure subject to the general deductibility rules. So the asset should be required exclusively and wholly for business purposes. And if the depreciation also is in line with the IFRS, it will be also acceptable. Whether we have depreciation, separate depreciation rates. So in the UAE, it's slightly different from other jurisdictions. Many other jurisdictions, there are cap or maximum rates of depreciation for assets that are provided by the tax legislation. We don't have this in the corporate tax law in the UAE. So basically, we are aligned on the accounting, subject to, of course, applying the relevant accounting standards, and also subject to the general condition of deductibility, mainly that the asset that you are depreciating is required, exclusively and for business purposes. So if you are depreciating an asset based on the IFRS, and this asset is not an asset that is used for business purposes, it's a private asset, of course it will not be deductible. The depreciation will not be deductible.
Thank you so much, Rida. What about individuals are not taxed on their salaries? So can a company decide to grant enormous salary to the managing director, who is the owner, and avoid profit in its bookkeeping?
It's a good question. So basically in that situation, the managing director is a related party. He's also a connected person because he is a director. So any transaction between him and the company needs to be subject to the transfer pricing rules and to the arm's length principle. So the deductibility will be limited to the arm's length salary in that case. So you cannot pay any salary in order to, of course, reduce the taxable base of the company.
Thank you so much. Last but not least, the last question to Zubair. Can any company or natural person elect for the small business relief, or will the FTA inform them whether they are eligible?
Thank you. Yes, so it's for natural persons or juridical persons, and they are expected to self-assess. So the FTA won't inform them. It's not an automatic relief. At the time of filling out the tax return, that's when they can claim SBR and fill out the simplified tax return. But it's something which businesses, natural persons or juridical persons should be identifying and self-assessing themselves.
Thank you so much, Zubair, and thank you for this. Ladies and gentlemen, as we conclude to our last session, we would like to let you open your cameras and scan the QR code for the survey, so we can hear back from you about today's workshop. Thank you so much for participating in the survey. As our time ran out and we're approaching the end of the workshop, we tried to answer as many questions as possible. We assure you that the Federal Tax Authority team will be keen to answer all remaining questions, and when necessary, the frequently asked questions section on the FTA's website will be updated. Thank you again for joining us today, and I also thank those who shared their important questions. And to stay in touch with the FTA, please follow us on our official channels on social media platforms to know more about any workshops organized by the FTA in the future. You can also visit the FTA's website to obtain the latest developments and contact us for your other inquiries. You can also contact the call center or use the Contact Us page on FTA's website to ask questions and inquiries. I hope that this awareness workshop helped answer your inquiries and provided a better understanding of the principles of corporate tax law in the UAE. Thank you and have a good day.